Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Hello and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Thank you for being here. How you doing, Paul?
I'm good. Good to see you, Brandon.
Good to see you. Well, today we are recording on Friday, the 13th of June. And I mentioned that because it's about 11 o'clock Central, 12 Eastern. And I mentioned that because we had some breaking news over the night, which was that Israel and Iran are entering into some kind of conflict, where Israel launched some attacks about 24, 48 hours ago on 3 Iranian nuclear sites. And there was a general of the Iranian Guard that was killed, and several other scientists were killed in their nuclear program. The contention was, Israel's argument is that Iranian officials and their military are enriching uranium to have weapons-grade nuclear missiles, that they are actually constructing them now. And in retaliation to that attack, Iran has launched over 100 drones that have struck some Israeli sites, and that their Iron Dome system has intercepted a majority of them, claims Israel. So I say all that to say that that has an impact on markets, as does any major geopolitical conflict, but especially one of this kind of magnitude. And so, Paul, you had some thoughts on how this might impact real estate. Now, granted, these are very large, complex issues with arguments on many different sides and different ways to analyze and understand conflicts like this. But these kind of political conflicts do impact markets, do impact real estate. And so there's a way of thinking about them and understanding them so that we can interpret what's going on around the world to make better decisions. And this is, of course, not to neglect or downplay loss of life and difficulty and challenges that people are facing around the world. But it's important to understand so that we can be better stewards of our capital. So with that long introduction, Paul, I'd love to hear your thoughts on what's going on and how you're interpreting this as an expert investor in the real estate sector.
Yeah, Brandon, thanks. It's not a great day. I don't think war is ever a good thing. We're going to cut a wide path around the political aspects of that because my opinion, your opinion on the political aspects, that probably don't matter to people that are listening. But I woke up early this morning. I generally get up early. I got up about 4 this morning, and that's the time of day where I usually look at sort of the macro level news and do some research at the macro level, because during my day, there's not a lot of time for that because it's so indirect to what we do every day. Early this morning, I saw that news, and I began to think about the potential impacts to our business, our investors, and it led to this conversation. I think it's really interesting. By the time this is edited and out in the marketplace, it will either hopefully have some value or it will be totally irrelevant because the conflict will already be over. Sure. So it's a little bit of a roll of the dice, right? But, the ultimate impact that this is going to have, and any conflict like this is going to have, this one is especially important because it's in the Middle East. And there's some different aspects to the conflicts in the Middle East in terms of how it affects our economy and things here in the U.S. But its ultimate impact will absolutely be dependent upon the scale and the duration of this conflict. So if it's over in 24 to 48 hours, then none of this will really apply. I think it's important to look at probably 4 or 5 areas where you can expect to see some impact if this conflict stretches out. I read early this morning that Israel made it very clear they weren't finished yet. So I'm sure Iran won't be finished in terms of their responses either. It looks like this will be at least a short to intermediate term conflict. If that is the case, if it's not a 48-hour event, I think the first thing you can expect is some market volatility. We're already seeing that. When I looked early this morning, mid-morning, the market was down about 500 points. And that's just risk-off selling. That's people, because of the level of uncertainty this conflict brings, they simply want to be on the sidelines. And I think you can expect to see that same behavior in the real estate markets if this stretches out for any length of time. The uncertainty that it creates on lots of levels will have people go to the sidelines, and I think you'll see a decline in the investment activity. If it goes on for any duration, I would expect to see cap rates expand. in most segments of the real estate industry. Not dramatically, but again, the uncertainty creates risk, and cap rates are at some level tied to risk. They're basically a reflection of the likelihood of the continuance of the existing cash flows. And so I think you could see some cap rate expansion. And lastly, under sort of the volatility category, I would expect, although it's interesting, I read some information that kind of could go either way. There's at least a possibility you'll see less foreign investment in real estate in the U.S., and that's a pretty significant source of capital in some sectors, or at least delays in deals. I think there's also an argument that the U.S. is a fairly, it's sort of the bellwether economy on the planet, and you actually could see more inflows of capital because this is sort of a safe haven. Whichever way that goes, I think in the beginning you'll see a delay in some transactions and some investments until there's a little more certainty how long this is going to last and what direction it's going to go. The next thing, because it's in the Middle East, and it's already happened, futures in the oil world have already gone up pretty dramatically. I think we can expect that if this goes on for any length of time, you'll see a surge in oil prices. And that's going to be related to inflation. So it sort of has a dual impact, right? It's going to affect transportation and utilities. It's going to affect the fuel side of that equation. It's going to affect supply chains and operating costs. And so I think for the real estate industry, what you can expect is particularly to see retail and industrial real estate affected, because the tenants in those sectors may see margin squeeze because of increased costs related to fuel prices. And then the other impact is inflation, which could either delay rate cuts, sort of the higher for longer scenario that has been talked about off and on, and could even result in increase in rates depending on how severe it is, how long it lasts, that kind of thing. And so that is the next category, right, is interest rates. I think the uncertainty that this creates will pause any potential cuts in rates and could result in that higher for longer scenario. And in real estate, debt costs are a pretty significant factor. I'll talk about each sector individually in just a minute, but I think it will make refinances more difficult because higher interest rates with the bank's focus on cash flow coverages are going to make it more difficult to refinance loans, which I think particularly first and foremost in the office sector, and secondly, potentially some existing multifamily deals could cause some real distress and issues. I'm not saying any of this is going to happen, Brandon, but I think these are all things that you sort of need to be thinking about and considering as you look at real estate. I think the other thing that inflation will do is result in expanded cap rates. Cap rates are a yield-related metric. The uncertainty will cause them to expand, but also just the yield basis will also probably drive a little bit expansion in cap rates and therefore some lower valuations. Again, this could be very short term, and if it is very short term, you won't see a lot of that. But if it lingers for a while, or if this conflict goes on like the conflict in Ukraine has, like the conflict in Gaza has, and stretches out to months and then even possibly years, sort of a slow grind, I think all these things, at some level become possibility.
Okay, help me. I want to try to recap everything you just said, because your 40 years of investing, you're running through this really quick. So I want to summarize it in just a second. But first, why are you arguing that interest rates, they may pause the cuts? What's the connection there?
Well, first of all, I'm not arguing for any of this.
I'm
simply sort of trying to look at this and say, what are the potential impacts if this conflict drags on for any length of time? I think that because this conflict is in the Middle East, because it may affect oil prices directly, because it may have some of the impacts I've talked about, I think it's likely that it could result in some incremental inflation. And the Fed has been very focused on inflation and related to any rate cut. So I think that's probably the biggest driver of that possibility.
So if I'm hearing you right, I'm not going to capture all of it, but if I understand what you're saying, conflicts like this create, first of all, negative sentiment, get a risk-off kind of narrative that goes through the market. Mindset. And then there's also impacts to oil, which is a major driver for a lot of real estate, whether it's developers or different factors, supply chain, things like that. And then that increases potential for inflation, which then will extend the delay for the Fed to cut rates in the future. And so, but it all depends on how long this conflict is.
Yeah, and there's
Among
one
other
other
things.
factor I referenced I didn't really talk about, but that's foreign capital, particularly in the
Foreign capital,
gateway
yeah.
cities. If you look
Yeah.
at Miami, New York, LA, those are markets where foreign investors, or San Francisco, huge foreign component in terms of foreign capital in San Francisco. Cities like that are probably the ones that are most likely to be impacted. And the absence of foreign capital, sort of in a risk-off mindset, could cause a slowdown in those markets. But there's also the possibility of the opposite effect. I can't really argue either side very well, but
Sure,
could
yeah.
be if they're seen as safe havens, you could see more inflows of foreign capital. But again, office seems to can't catch a break because a lot of the foreign capital that comes into the U.S., it goes into all sectors, but office is one of the ones historically that have been sort of particularly, like office buildings in New York or L.A. have been the darlings of foreign capital. And it's already sort of wobbly and fallen to its knees. And the absence of that foreign capital could be, another negative aspect for certain types of real estate anyway. So I think you should expect increased volatility in pricing. If this lasts any length of time and rates creep up or hold here for longer, I think there'll be some difficulty in refinancing and financing. I think there'll be a reduction in transaction volume until there's more certainty. And I think there'll be sector-specific weaknesses. If you want to, we'll talk about that next, because I kind of looked at each sector and thought about what are the potential impacts in those particular sectors as I looked at the markets.
Last episode, we talked about a lot of the different sectors and how you're seeing kind of this mid-year outlook. So I'd love to hear kind of that same, or what are the different sectors, how you're interpreting and what they may experience in the future.
Yeah, let's go from worst to best.
Okay.
Let's start with office. If this conflict is protracted, I think you have several negative impacts on the office market that will just make things more difficult than they already are. Overall, this event, if it lasts any length of time, is negative for the office sector. It's already struggling. If you see higher debt cost, it's going to make it much more difficult. If you remember, we talked about the fact there are hundreds of millions of dollars worth of loans that are due to be refinanced this year. If interest rates move up at all or don't move down, it's going to make those refinancings more difficult, which is going to result in defaults. The market's already dislocated, and none of this is going to help it. And the lack of foreign capital in certain markets could also hurt. So office, I would definitely say this is a negative impact. Retail, although not necessarily the grocery anchored retail we talked a lot about in a show we did not that long ago, but retail in general could see some struggles on the tenant side because of negative consumer sentiment. If this protracts, if inflation goes up, if rates hang here or go a little bit higher, the U.S. consumer could put his hands in his pocket and keep them there for a little bit. And that's never good, if you're in the retail space. Industrial, I think it's mixed. I don't expect huge negative impacts, but I do think there could be some supply chain disruption and some increased cost for industrial tenants related to oil prices. And stress on tenants ultimately results in stress on landlords, right? Tenants can't pay the lease, or if they're struggling and either downsizing or not growing, then that ripples into the landlord side of the equation. Multifamily, I think the impact is pretty mild. I really think multifamily is relatively, the higher debt costs won't help new development, but less new development won't hurt multifamily as a sector, really, because it's coming out of an overbuilt state right now. I think you may see rent growth slow a little bit if inflation ticks up and consumers' disposable funds become a little tighter. But overall, I think the impact is fairly mild. And then the last two categories, I talked about industrial in general. We can talk about the small bay industrial that we developed, because I looked specifically at that because, we have, pretty big vested interest there. I think the impact is mixed. I think a lot of the tenants, our tenants in the small bay world are more consumer-facing businesses. So to the extent consumer sentiment ticks a little more negative, that's not going to be helpful for the tenants. Fuel prices, the last mile logistics folks and landscapers and HVAC contractors and all those types of people that you find in small bay industrial, their businesses are impacted by higher fuel costs. So there could be some drag on the tenant side of the equation in small bay industrial, but I think the impact overall is mild. I did even more digging to get sort of people's views, again, not specifically on Iran and Israel, because although the drumbeat's been happening for the last few weeks, nobody's really looked at that specific event. But looking at events like this, particularly ones that impact the Middle East, there's a little more data and a little more information out there. And self-storage, and this sounds self-serving. I've said that before when we talk. But the reality is self-storage is so resilient that it tends to outperform all the other segments in an environment like this. I really don't see anything that raises real red flags. I think there's a mixed bag. I think there's some aspects of this that'll be negative for self-storage. I think there's some that are neutral and even one or two that are positive. So I think on the whole, if you look across all sectors, multifamily and self-storage probably sit in the best seat this environment if this conflict gets protracted. I will say both those sectors are sort of climbing out. We've talked about the bottoming process and that they're sort of at a critical point of transition. And that bottom could get flat for a little while. It may not be a U-shaped bottom. It may be more of a box-shaped bottom where the recovery is slowed a little bit because of some uncertainty in the market. Transaction volumes would probably drop. Valuations may not be quite as attractive as they might have been otherwise. And rent growth may slow a little bit. So none of that's positive, but I don't see any significant negative impacts to multifamily and self-storage. And really, industrial, retail, and small bay industrial, the impacts are all mild. It's the problem child office that's in a really vulnerable state. And if this gets extended and rates do go up, I think you could see the defaults in the office market increase significantly, and they're already pretty significant.
Thanks for that. That's helpful because it's, real estate in general, markets in general, but then when you kind of slice them up and you get more fine-tuned, there's definitely a lot of factors that are going into it. Just what's going to happen. But not that we know what's going to happen. We cannot predict the future. But I am curious, what would you say, let's say for the next 7 to 10 days or the next couple of weeks, what should investors be watching? Is it that they should take a look at the length or escalation of conflicts like this? Or are there particular sectors within equity markets or commodity markets or things that they could read in the news that would help them kind of give a sense of what may be coming in the future or how you interpret it?
First of all, I think the length of the conflict and the severity, the intensity of the conflict is probably the biggest thing. Hopefully this is over in 7 to 10 days, and this podcast will gather, mothballs somewhere, because nobody wants it to look at it. But I think the duration and the severity is a key aspect. I think how many players get drawn into this. I think the impact on oil right now, the short-term impact we've seen in the futures market is sort of short-term and somewhat opportunistic, perhaps, by the traders. Iran is a major source of oil. There's no doubt about that. But if Iran is the only disruption, it won't have a longer-term impact on oil prices. If this becomes a wider conflict in the Middle East, then it could have a more serious, longer-term impact on oil prices, which then drive inflation and all the things we talked about. So I would watch the futures market a little bit. After you get out of the first few days of this, the reactive part of the market will have worked its way out. Looking at longer-term contracts in the oil futures market will give you a real idea where the professionals think oil prices are going. To me, that would be something that I would definitely watch. I think those are probably the two biggest things. The wider the conflict, the more people that get involved, and hopefully there won't be anybody else involved, and this will get resolved quickly. If Europe gets involved, if the U.S. gets involved in any way, if other countries in the Middle East get involved, then, with conflicts already, the Gaza situation in the Middle East and the Ukraine conflict, which doesn't seem to be able to find a resolution, at least not yet, it's a pretty unstable environment geopolitically. It could have some broader impacts down the road.
Yeah, for sure. I know the U.S. earlier this week, 4 or 5 days ago, they evacuated the U.S. embassies in parts of the region. So, maybe they were expecting something, and
I think they had a I mean, everything I've read, and again, we're not going to touch the political side of this, but everything I've read is the U.S. was discouraging Israel from doing what they did last night, but probably, my guess would be, had some idea it was coming. And so that's why you heard some warnings, from our government, and you saw them pull our embassy folks out, the non-essential people out. I think they had a sense this was coming. And, it could get real interesting in a negative way if part of what happens here is the U.S. gets blamed for this, even though I don't think we were involved. Again, I have no idea. But you see some retaliation, whether it's domestic terrorist attacks or in Europe or in the U.S. That's a whole different destabilizing sort of series of events that starts to create more uncertainty and highlights all the things we've already talked about. Let's hope that doesn't happen. But
Great. So just to give an update, I'm looking at markets right now. It is currently 11:33 Central on Friday, and the S&P is down 0.4%, and the Dow Jones is down just over 1%. But it looks like things are trending a bit back up from where they were about 9:30 Central this morning. The S&P bottomed out about 59.93, and it's back up to just over 6,000. So we'll keep watching. But Paul, is there anything else that you would advise the folks to listen to or think about?
Well, I guess I want to make a comment, Brandon, because I don't want our conversation to be sort of taken in the wrong way. I don't think any of this shakes my confidence in or willingness to invest in commercial real estate. It's simply one of those contextual events that you have to consider. In our world as a developer, I've said this multiple times, where the economic environment goes over an intermediate time frame from 3 to 6 years is really what affects us. What happens in the next 90 days really doesn't, because the properties we're building aren't directly affected in the short term. It's a 4-year lease up in storage and 6 months to a year in the small bay industrial product. So I am not negative. I'm not saying run from real estate. This is not a good time to invest. I just think you have to have these contextual backdrops as part of your overall decision-making process. And it may cause one to pause and sort of, we're less than 24 hours into this, right? We'll know a whole lot more in 24 more hours and a whole lot more in 5 days to a week. And so, I would probably take that into consideration in terms of making decisions. But on the whole, I don't think this is a super negative event for commercial real estate in the United States. But it's just, it's one of those things you deal with. And this is the third time in the last 3 years we've had a conflict like this break out that, has some level of implication for the economy in the U.S. So.
Yeah, it's important to always analyze what's going on in the world, because it always, markets and geopolitics and cultural issues are all intertwined. But what I would encourage listeners to is listen to the previous episode 15, where we look at a mid-year outlook and run through those real estate sectors and give kind of a general overview of what we're seeing in markets compared to this episode and what we're seeing here, because they all relate, but it's helpful to see, I guess you could say, like a multifaceted analysis of how things like this are impacting the fundamentals, because we went through the fundamentals last episode. This episode, there's some, just things are changing. So I would also love to hear from listeners or folks watching or even on social media. Find Paul, find the AAA team, find Andrew Frowine, email andrew.frowine@AAAstorage.com, FROWINE. I would love to hear from folks. How are you guys interpreting some of this news or different things that might be helpful for your own analysis when you're thinking about it? But it also underscores the point, trust a very good sponsor like AAA that is reviewing these things in real time so that they can make the best decisions possible and give you guys the best thoughts and interpretations of the market that are available. So anyway, Paul, thank you for looking at all this. I know you were up early looking at all this for us to get some real-time news and analysis. And so we'll try to get this podcast out as soon as possible. And hopefully encourage conversations, but also just more analysis on what's going to be happening over the next few days. So we'll keep you updated.
Yep. And thanks, Brandon. It's always fun to get together. And again, I want to make sure people know I'm really not being negative. It's just in the U.S., we tend to live in a bubble, right? We're so insulated from the rest of the world. If you spend any time in Europe, in Europe, going from one country to another is like going from North Carolina to South Carolina, and they're much more exposed to what's going on in the world. Sometimes we tend to not think about it as much, and so this is just a contextual piece. I don't think it's bad news. In fact, I think there's a very low probability that it has anything other than a short-term impact, and a few deals get delayed because people kind of wait to see what's going to happen over the next couple of weeks. I don't think there's going to be huge impacts, but all the things we've talked about are possibilities, and so I think they just have to be factored into your whole thought process.
Yeah, that's right. Yes, cannot predict the future, but it's helpful to think through. So, Paul, thank you. Like I said, I will try to get this out as soon as possible so folks can take a listen and respond and keep the conversation going on how everyone's interpreting what's going on. But I know you'll be keeping an eye on it, and we'll be back at you next week.
You got it. Thanks, Brian.
All right. See you then.
Take care.